Standard carbon project finance follows a clear sequence: secure land rights, deploy capital, achieve the ecological result, and finally verify the outcome for credit issuance. But the current carbon market is experiencing a structural failure at this final link. Projects can secure capital and execute perfectly, yet still default on their debt. These defaults occur when retroactive changes to regulatory rules alter the accounting of nature after the capital has already been spent. Methodology risk now represents a legible, quantifiable project finance risk. Treating verification as an ex-post reporting requirement rather than an ex-ante design condition is the most dangerous mispricing error a developer can make. Australia's Soil Carbon Method Review provides a precise look at how regulatory shifts alter project economics. The review was conducted by the Emissions Reduction Assurance Committee, the statutory integrity body for Australia's carbon crediting scheme. Their decisions bind live capital. This wasn't a total invalidation of the method. In fact, the committee found it met 5 of the 6 mandatory offsets integrity standards. However, the regulator's specific remedy for the one failed standard altered the cash flow assumptions for every active project in the scheme. We need to look at how a project's financial model can collapse even when the underlying methodology is not technically canceled. The audit began by sampling actual project reports submitted by soil carbon developers to see what they were claiming on the ground. Developers claimed an average undiscounted accrual rate of 7.4, with extreme outliers claiming rates well above 20. But peer-reviewed scientific literature doesn't support soil carbon accruing at these speeds. The regulator's response was a surgical intervention, a conservatism ceiling capping crediting at 3.0. A ceiling of 3 might sound like a minor adjustment, but the impact depends entirely on the unit of measurement. That unit is tons of soil organic carbon per hectare per year. This is distinct from the standard market unit of CO2 equivalent. In soil carbon, the two differ by a factor of roughly 3.7. By imposing this 3.0 cap, the regulator effectively mandated a massive haircut to the volume of credits a developer can issue, creating a mathematical collision with the project's financial obligations. The mechanics of the decision are specific. Any units calculated above the 3.0 ceiling are temporarily withheld rather than canceled, pending proof of durability over a 25-year period. This withholding attacks the financial model through 4 separate vectors. Vector 1, lower near-term issuance. Vector 2, delayed revenue. Vector 3, added operational cost. Vector 4, off-take delivery shortfalls. These 4 bottlenecks converge on the balance sheet at the exact same time. A project can breach its debt covenants and see its asset valuation entirely obliterated simply through delayed issuance, long before a regulator formally writes off a single credit. Developers often miss these risks because they confuse ecological data with financial accounting rules. The market's assurance machinery is actually a stack of 4 distinct layers, each operating with different legal weight. At the bottom, tools like Global Mangrove Watch provide sophisticated satellite mapping. This observation layer proves ecological change, but it does not grant the legal right to claim a carbon credit. That translation happens here, at the methodology and accounting layer, where the soil carbon review took place. This regulatory layer is entirely separate from registry infrastructure, like Verra's durability pilots, or broader market architecture opinions. If a financial model relies on the certainty of satellite observation without accounting for the volatility of the methodology layer, it is structurally blind to regulatory risk. The Australian case study provides a specific price and framework for methodology risk. For practitioners, the mandate is clear. Verification can no longer be treated as an administrative stamp at the end of the project. Financial models must be stress-tested against conservative crediting ceilings, delayed issuance, and revised leakage protocols before capital is committed. This risk must be integrated into the legal architecture of the deal, with contracts explicitly naming who carries the financial burden of a methodology change. Agreements must dictate exactly what happens to delivery obligations if units are placed into temporary withholding. If you do not proactively price methodology risk into your contracts early, the regulator's methodology will price it into your balance sheet later.